Hi everyone, so welcome to my YouTube channel, and you're watching this on my YouTube channel, of course. I'm Will Chia, and you're watching this topic of equity investments, introduction part 1. I think this is an interesting topic which I've been thinking about. I've been trying to find time to do this. Finally, I have found time, right? So this is at the expense of developing other videos. But anyway, I'll come to those videos hopefully soon, right? So we will start with an introduction to securities and the different asset classes, followed by a walkthrough of my personal fascination in equities, why equities will be the third part, followed by a closure. So I met many people and they have asked me, like, what do they do? Should they invest in so and so item or whatever item it is? So there are various questions that I get from time to time. I mean, after all, I teach accounting and finance, and investments happen to be a related subject. So people tend to ask me that question. But anyway, in the investment world, there are various asset classes that that we can get in touch with. And most of them are quite accessible depending on which part of the world you live in. So there is, of course, the very common one, equities. Right? Plenty of books have been written on equities. And if you are an accountant, you probably have heard of this. If you are a share investor, all the more you should know what these are. Okay, followed by bonds, property, and property is a very important asset class that the place where I live in Singapore, people believe that that each and every person in Singapore must have a property investment. So, of course, there are others who believe that equities are more interesting than property. That really depends. Now, one more asset class which is quite interesting is commodities. When I say commodities, it will be things such as gold, rare metals. Now, gold, interestingly, has retained very good purchasing power. In fact, it is a very good instrument to preserve purchasing power. Right? My mom used to be a big fan of gold. Well, then there are the other asset classes, which those are not part of the topic today. Right? Each of these asset classes have its own unique liquidity, risk and return profile, right? And what works for some investors may not work for others. Now, what is also very unique is that each of them differs in terms of the denomination. The denomination can be quite different. Okay, like for example, you could purchase tens of shares of a certain company depending on which stock market that you trade in. Like in Singapore, the smallest denomination can trade for a stock counter is hundreds, 100 at least. But in the US, you could trade less than that. It could be by tens of shares. Correct me if I'm wrong, right? And previously in Singapore, if you want to invest in equities, you have to trade by thousands. So the smallest denomination actually presents a certain consideration for investors. I mean, let's say if your capital is limited, then that results in yourself being an investor being restricted to certain types of stock investments. So denomination plays a key part here. And if you understand denomination, then you understand why property is actually quite a difficult asset, okay, to trade. As in, it's very difficult to cut the house into half and say that you want to sell half of a house, right? So the smallest denomination for a house is actually one house or one apartment. You cannot have half a house being sold, right? Unless you invest in the REIT, where the REIT would allow an investor to purchase parts of its property portfolio. So then again, as an individual, if you try to invest in property, that is the problem that you face. You can't sell half of a house, you can't sell a quarter of a house, or to quote what David Kuo from Motley Fool has mentioned before, and I think it's very meaningful. He says that you cannot sell a house brick by brick, which is exactly right. I agree with that statement. Well, then that's where I'm very inclined towards equities, because equities allow an investor to sell a share unit by unit, which is very important, right? And that's the unique what you call that denomination. I mean, that's the unique thing which I would like to emphasize, that these investments are really differentiated by the denomination. Okay, we are not going to look at the others, but okay. So what do we mean by equities? You might be a share investor for a long time to come. You might be an accountant, but whoever you are, let me just explain my piece here, how I interpret equities. So let's try to understand the concept. Right, a business may have $2,000 of net assets. His equity is also $2,000, assuming. And let's assume further that we could divide all these into 1,000 parts. So if you were to take $2,000 divide by 1,000, that tells us that each part would be worth $2, and each part is better known as each share is worth $2. Now, and which means that if you could take $2 to pay for a share of the business, this is a fair price. Obviously, if you could pay lesser than $2, then it is a bargain, right? Of course, you know what you hope that is you do not have to end up paying more than $2 per share. That would be horrible, all right? So that, you know, that's the idea about equities. When you buy into equities, you basically purchase into an ownership of an entity, right? To be more correct, part ownership of an entity. So that part ownership is very important, because that's the idea about buying into a share, because you want to have ownership, right? Part ownership of an entity or business. And you would like to do so without going through certain processes, all right? So this is the idea about equities, where we actually get an opportunity to purchase shares of a business and enjoy part ownership. So that's the concept behind it, right? The greatest advantage in equity investment is that by investing in equities, you avoid having to go through the process of raising capital to run the business that you always have dreamt of, right? Imagine yourself, you wanted to start a bank, okay, as big as Citibank, for example. Now, how many years do you have to slog and, you know, work late nights in order to be able to start the next Citibank, for example? It probably take many years, and you might not be able to see the fruits of your labor, all right? So if you were to invest in a share of Citibank, you would have immediate ownership, part ownership of Citibank, without having to worry about raising capital to start a bank. You don't need to worry about regulatory requirements that you have to fulfill before you can start a bank, because by investing in the stock, you are already a part owner of a part of the business. And you will not need to worry about how best to run the business, right? And even managing the daily affairs of the business. And if you imagine operating a business, it is a lot of work, a lot of effort, and a lot of planning. So the reality of starting a business from scratch is nothing but daunting, unless you're very well prepared, unless you have huge amounts of capital behind you, backing your endeavor. If not, there is a very real learning curve. Okay, and you have to go through that learning curve before the business starts to take off and become economically viable, and that can be quite a while. Okay, starting a business is not as easy as cooking a packet of instant noodles. It's not as easy as that, right? The stakes are big, and most of the time, whatever capital that you have injected are mostly illiquid by the time when you think of exiting, if you ever have the opportunity to exit the business. And the only time when you can actually exit a business that you have started is when there is someone interested enough to want to buy out your business. Now, that is difficult, right? Because by the time when the business is truly that economically viable, why would you want to sell off the business unless you have a better use for money? Okay? And real business issues are not easy to contend with. They are very challenging. Like myself, I went through the process of starting a business, and fighting with issues such as consumer demand is really no small affair, because you would have to think about how to get consumers to be aware of your product, and also fight against all these near and direct competition. Alright, because you might think that you have a good location, but then hey, wait, you might have a competitor online who might be selling the same product, and that is not a very easy thing to fight with. Right, consumers just love convenience. Consumers love value for money. Right, at least that's what most of them would like. And how would you be able to compete against consumers, alright, who like to just buy things for a certain good price online? It's very difficult to overcome that. Okay, so that's the issue. It's daunting. So why equities? Well, the powerful advantage and benefit of equities is that by actually investing in an ownership of a business, you get away with all these difficulties and hurdles, right, and also insurmountable challenges facing business owners, right, such as cash flows, budgeting, getting financing from the bank. All these are surely not easy, right? If you want to be able to raise finance quick, that is also difficult, because you have to know the bankers well. You have to be able to convince the bankers that that you do deserve that lifeline. Okay, not very easy at times, and bankers may not be on your side all the time, right? And then once more, if you needed that additional trade finance, how would you be able to get it from suppliers? Not very easy. Okay, it might be easy, it might not be. It depends on your relationship. So there are various factors that is, that a business owner has to consider, and all these are real problems. However, if you invest in equities, you gain direct access to experienced management that has seen it all, though presumably the case. You also gain access to competent staff. You do not need to worry about human resource or recruitment or to get the right people to do the job, no. Because all these with staffing is already arranged, already planned by the company. So you do not even need to worry about having the right people or even monitor what they are doing, because all these will be managed by the business management. You also benefit from an established business. The business is already up and running. You do not need to go through the learning curve before this business starts to become economically viable. And yes, not forgetting last of all, you gain part ownership of real assets. Right? So if the business owns a building, you would also have a share in the building. Right? You will also have a share of the ownership of the building. And that type of ownership is very difficult to achieve in real life, considering that inflation rates today is just madness. So as an equity investor, you place your hard-earned money with the company's management. And we assume that company's management are competent, experienced, and they know what they're doing. And they would know how best to manage your hard-earned money. You delegate the work of managing a business to, of course, supposedly competent management and staff. So equity investment as such is quite attractive, because you could still go on with your daily life, have a job, right, or maybe your own business, and yet someone else who has taken your money and allowed you part ownership of the business would then have to make sure that the business is properly run, and then of course in the process of doing so, growing the business, they would then indirectly or directly help to grow your wealth. So that's the amazing thing about equities. Equities also enable an owner, or rather an individual, to have not just part ownership in one business, but multiple business. That's amazing. Because how many years do you need to take before you can get a business up and running? It might not be immediate, it might take quite a while, right? To start Amazon or eBay is surely not an overnight process. It took them time. Right? What about Ford Motors? It took them 100 over years. Right? So to start a business is not an easy process. but through equity investment, you become an immediate owner of multiple businesses. This beats the process of having to do the same thing like raising funds to raise multiple businesses, and hoping that you have the time to run all of them. Unfortunately, being mere mortals, you can never find the time to exercise direct management over multiple businesses. You would still, end of the day, end up having to delegate the duty of management to certain people. Right? So that's where we end up with equities, which is much more sensible than having to find ways to raise capital and start a new business. Right? The opportunities in equities are tremendous. Right? You might think that, well, there isn't any, or you don't believe that there is any. Within the stock market, there are many cherries to pick. The real challenge for the stock investor is how to pick the counter which is undervalued, or to use the other word, cheap. How would the stock investor be able to identify and pick the cheap stocks? Now, picking cheap stocks is not a very easy job. Okay, it can be quite difficult because many a time asset values might be obscured by various accounting policies and treatments. Right? So accounting policies and treatments may obscure the real asset values of a business. So real asset values are never quite well represented in share prices, because the price that you see for a share today is only but what the market believes it is. Right? And the market can be very irrational. So the additional challenge here is really, how do you assess the disparity between real net asset values and share prices? Is the disparity attractive enough for you as an investor to invest in the company? Or is it not attractive enough at all? So obviously we'll hope that the real net asset value should be greater than the price for the share. Because where the price that you pay is much lesser than the real net asset value, that's where as a stock investor you have picked up a bargain. Right? So how do you find these? Well, back in 2008, I had the benefit of being able to invest in DBS, and I invested in DBS for cheap, $5-6 in 2008. Right? Now, how did I know that I was having a good bargain? Well, that was the story in the past. But what I did realize at that time was that the price was far below the real net asset value of DBS. DBS is the Development Bank of Singapore, Singapore's biggest bank. So, I mean, for an investor to find all these is actually quite an art as well as a skill, science even, right? But identifying this disparity is what rewards investors, because the moment you are able to identify all these disparities within those counters that are so-called undervalued, that's where you would be outstanding. You would outperform the market. But finding these counters are, of course, quite a difficult process, and it takes years before these real values are realized in the share prices. So, having said all that, I hope that has explained to you why I thought that equities are an interesting asset class to invest in, right? So, in sum, we have covered some of the essentials of investments in this part 1 of this video series, and hopefully in the following video we will try to cover some valuation methods that are commonly used. Thank you for watching, and I'm Will D. Chai. You've been watching this on my YouTube channel.